Yeah, that's right. I mean, the inflation gap between the US and euro area is going to be widening at least over the next 2 quarters. In the US, we see very sharp disinflation, and that's largely coming off on the back of crude oil prices coming lower, and so energy inflation in the US is coming down. In contrast to that, in the euro area, there's the huge shock from the surge in European natural gas prices and electricity prices, and that is continuing to push inflation into double digits over the next couple of quarters. So really, by the fourth quarter, we could be in a situation where the Eurozone is still sitting with a 10-12% annualized inflation rate, whereas the US is down to 3%. What that's also going to mean is a substantial hit to household real incomes in the Eurozone, and that, in our view, will induce a mild GDP contraction, a mild recession starting in the fourth quarter and into the first quarter. In contrast to that, the disinflation in the US is going to provide a boost to household purchasing power, and therefore we think the US will kind of chug along at this roughly 1% growth rate and skirt a recession in the second half of this year.
Nora, is a 75 basis point hike sort of the panacea to Europe's inflation problems? I mean, the messaging out of Canada to lead sort of advanced economies in many ways is kind of the same as you'd maybe expect from the ECB and maybe even the BOE.
Yeah, exactly. At this point, the ECB in particular needs to get policy rates much closer to neutral territory. It's sitting there with a policy rate of 0%. So it has quite a lot of work to do just to get up to neutral, which we think is around 1.5%. We think today it needs to go big. We're expecting a 75 basis point rate hike. And then subsequently, we think it will need to hike again 50 basis points in October and possibly another 25. So really, the ECB has a fair bit of work to do here, and that's largely in response to soaring inflation, as I mentioned before, and continued and quite broad-based upside surprises in inflation relative to its forecasts.
Nora, one thing, and you touched on this earlier in your conversation with that Abele that came out of your global economics report, I think it is really interesting to just unpack this in further detail, but you have forecasted peak global inflation. And what stands out to me is that you think the largest disinflationary impulse is going to come from the US in the coming months. So talk us through how you see that panning out.
Yeah, so I think it's worth pointing out that globally, we're sitting here with about 9% inflation rate. And what's very clear is in the next few quarters, I think just the falling crude oil prices is going to generate quite a bit of disinflation globally, in the US included. On top of that, there's going to be a easing in core goods price inflation momentum, and that's largely in response to the slowing in global demand and also the easing of supply chain constraints. So actually, it's quite easy to get inflation down from about 9-10% to around 4-5%. And the US is going to be benefiting that because obviously it doesn't face the shock that the Eurozone faces. I think the bigger question, though, is how do we get from a 4 or 5% inflation rate all the way down to 2%, which is what the central banks are targeting in developed markets. And that's, I think, where the question about how much more tightening central banks need to do and how much further they need to get into restrictive territory